Let's get across the market open. Marcus Padley joining us from Marcus Today. Marcus, welcome to Wednesday. Focus last night on Wall Street, clearly coming from Fed commentary. We heard from Jerome Powell, perhaps tempering prospects of further rate cuts. There's a bit of a play going on here between those Fed members. We also heard from Michelle Bowman clearly advocating for deeper cuts.
Yeah, well, he's walking a fine line, isn't he? And as he said, it is a difficult line to walk between the jobs market weakening and inflation at risk. And I think he's hedging his bets on policy that in case inflation picks up in the fourth quarter, and so he's not promising any rate cuts from here. Although the market is assuming, and if we get an okay inflation number on Friday, the market's going to continue to assume we're going to get a rate cut every meeting from here to the end of the year. And Andrew, it's a very powerful driver. When you talk about money, what drives the market is money. And a Fed meeting that starts a rate cutting cycle is a powerful turning point for a lot of fund managers who will sit and in their asset allocation meetings and in their ivory towers in New York or Singapore or wherever they are. And with an interest rate cutting cycle starting, that will push them to go risk on. And that means equities. And if you have a look at what's happened since the Fed meeting, the US market's up 3.3%. This month, in anticipation of Fed cutting, it's up almost 7% in less than a month. This is powerful stuff, and it reflects money coming into equities from big funds management groups because they see less risk against an interest rate cutting cycle. So that could obviously be caught short by, as Powell points out, an inflation risk. We'll see it Friday. We're going to be watching every inflation number now. So Friday is very important with this PCE price index number in the US.
Yeah, Marcus, I mean, you're obviously invested there in the US, but you're saying you don't want to stand in front of that momentum at the moment.
No, I think you have to understand, everyone lives, especially when the market's gone up the way it has, the US market in particular, everybody lives in fear of some massive collapse suddenly catching them all out. Against this backdrop, it's very unlikely. The market, with the Fed cutting rates and fund managers favouring risk assets, which includes equities, things are less volatile, more safe. And I don't think we really have to worry about some sort of vicious collapse, and certainly not if it's based on a fear of overvaluation in the US market. It's not an ingredient that's going to cause some sort of precipitous fall. You'd need something truly shocking, and overvaluation isn't it. So I think we can rest assured, but you can never really rest in the stock market. We just have to keep waking up every day and deciding what to do. For the moment, I think things are looking fairly comfortable and safe, and any pullback against this backdrop will probably be bought anyway. So risk seems low.
Well, speaking of overvaluation, look, it is still a narrow leadership there, certainly among those mega cap tech stocks. How comfortable are you with that AI trade at the moment, given the likes of NVIDIA obviously continuing to spend?
Yeah, well, sentiment on it can change, but this is when you look at what NVIDIA's saying, NVIDIA's spending money, $100 billion yesterday with OpenAI. It's only a letter of intent, I've got to say at this point, and it's over years, isn't it? And $5 billion last week with Oracle. Is it Oracle? Yes.
Yep.
This is the sort of stuff that is crucial to big tech sentiment, is how far out is the horizon? How big is the capex? And NVIDIA are telling you the horizon is years away and the capex is endless. So, and the other hyperscalers will be looking at what they're doing and thinking we better get on with this as well. So it's a fabulous theme. Even if there is some sort of setback, it's probably going to come from something non-big tech related. some market event. And if that happens, I think the theme is long-term enough for everybody to be looking to buy it on any setback. So fairly comfortable with big tech, but as always, never take anything for granted. Things can change. For the moment, pretty comfortable.
And Marcus, gold continuing to scale new heights there, obviously boosted by the prospects of rate cuts. Have you got exposure there?
No, don't have. Got FOMO on gold, but gold's a very small sector here, and it's a little bit like being in the casino. We've got a process which is working. It's quite low risk. It's quite long term. And over in the corner there is a guy jumping up and down, making a fortune on gold. We can't catch everything. Henry's in the newsletter. Henry's caught it in his small companies portfolio. But our strategy doesn't need to include gold, although the drivers are very strong, which is, again, money. Central banks are clearly rotating back to gold. And when the US dollar falls 12% in a year, which it has done, that boosts everything priced in US dollars. So that's been fabulous for the gold price as well.
All right.
But we don't need it to succeed at our goal.
So, Marcus, what is your broader strategy at the moment? And does Australia feature in this at all at the moment, given it has certainly underperformed to this point?
Yeah, it has underperformed. Our market, ASX, is up 8% this year. Nasdaq's up 18%. So we're in the right camp. We don't hold anything in Australia at the moment. Our goal has been to achieve, we've got something, Andrew, called Target 20 on our fund, which is targeting a 20% return per annum, which might sound ambitious, but if your target is, I want to outperform by 0.1% per annum, you're going to sit there twiddling your thumbs and playing golf, aren't you? Because it's not very demanding. So we've got Target 20, which is get a 20% return per annum. We started in February. We're at 19.46% today. And we thought today we might just hit the 20%, but the market's tipped over a little bit. So we're going to be bumping that ceiling, but that's our goal. It's been US and big tech that's achieved that so far, and we're fully invested and will remain so until something tells us otherwise. I saw that Wilson Asset Management fund manager yesterday in the AFR saying Australia, of course, it's lagged. We've got old world industries, banks and mining, and we have, all the growth is elsewhere at the moment. So we'll play where there's growth rather than in old world industries.